Hey everyone, welcome back to whatever this is. I guess it's a weekly show now. I'm Jeff Dorman. I'm the Chief Investment Officer at Arca, live from our Los Angeles headquarters here. This week in That's Our Two Satoshis, which is our weekly market recap, we talked about a couple of different things this week about what's driving the market. What's interesting is, this is an industry that was built without a lot of institutional support and only later started having institutional interest. But you can start to see some of the direct effects of more larger institutions getting involved in this industry when you have a week like last week, which straddled month end. It also straddled quarter end. So September 30th, I think, was on Thursday. It was a pretty rough week for risk assets up until the 30th. You had equities were down about 3%, capped off a month where the VIX had risen 40%. You had treasuries losing about 1.2% as the 10-year yield rose almost 20 basis points. It was a pretty rough month, and it was a rough end of the month as well, up until Thursday. And then immediately, like a flip of a switch, as soon as we went to October 1st, it was up only across every risk asset, including digital assets. So it was pretty interesting. What we think about this is, some of it is self-fulfilling prophecy. I think everybody at this point has seen this chart about Bitcoin returns since 2009, and clearly September has been one of the worst months historically. And October has been one of the best months. In fact, all of the fourth quarter has been great. We also saw the exact same scenario last year where we headed into the fourth quarter and Bitcoin had lagged and the market had lagged a little bit. And then all of a sudden, the fourth quarter was a rocket ship. So there's a little bit of self-fulfilling prophecy in there that people were expecting October and the fourth quarter to be better. And as soon as you saw the calendar shift, it just so happened to be there. But I think it was more than that. I think if you actually look at what's happened this year, we started to analyze the first 10 days of the month relative to the rest of the month for each of the months this year. And it's pretty stark difference in returns when you look at it that way. So the first 10 days of the month on average, this is the Bloomberg Galaxy Crypto Index, which is, not necessarily the best representation of the digital asset market because it's, 80% Bitcoin and Ethereum, but it's close enough in terms of tracking purposes. The first 10 days of every month this year has had an average return of 14.5%. And then the rest of the month, the next 20 to 21 days, has been on average down 2%. And in fact, there was only 1 month the entire year, which was July, where we actually reversed, where we had a rough start to the month and then it finished strong. And of course, that was after 6 straight weeks of declines from May 20th down to July 20th, or 8 weeks, I guess, of declines, which led to that reversal. So pretty stark data there. What we think about this is we think this is directly related to institutional fund flows. So most venture vehicles, most liquid hedge funds, onboarding of new accounts, a lot of that stuff has a real calendar focus where you just don't get new money in until the end of the month. And we're starting to see that play out because each month this year, funds like ours at Arca, competitors of ours, OTC dealers, et cetera, we're all sitting on piles of cash to start the month. And what do? You start to deploy it. And I think you're starting to see that pretty clearly now in terms of the market. So it's a little more difficult to measure. There are some folks out there who are doing a pretty good job of measuring fund flows into exchange traded products. I think CoinShares does it, where they track the flows into specific assets like Bitcoin and Ethereum and even Solana through these ETPs. But that's really not telling the story because the majority of the money that's coming into this space is coming in direct through OTC dealers, direct to exchanges, direct to private funds like Arca's. And it's that cash that you can't see that's really driving these returns. So pretty strong inflows all year. Saw it again in October, and you're seeing the benefits of it right now with a market that's up over 10% in the first few days of trading here in October. So what do you make out of the rest of the month here? You have to talk about the macro situation, right? We've got all kinds of concerns right now from a macro standpoint. The debt ceiling being the one that most market participants are talking about, but really you're seeing across a lot of places, right? There's an energy crisis going on. There's supply chain issues. We're seeing weaker growth. Clearly, there's problems in China with Evergrande as well as just overall leadership from the CCP. So this is definitely weighing on the market. I want to focus a little bit on the debt ceiling specifically because this is not new at all what's happening here. In fact, we saw the exact same thing play out in 2015. The chart that we have in Two Satoshis is showing what happened to 1 year CDS for the USA. So the USA is largely viewed as safe and no issues. CDS generally trades at about somewhere between 5 and 10 basis points. CDS being credit default swaps, which is basically just an insurance policy against a debt default. I think most people in the world think there's almost no chance that the U.S. government is ever going to default on its debt. But you can see during these debt ceiling fiascos that the CDS will rise. Back in 2015, it went from 10 basis points up to 45 basis points. This year, you see it rise from 5 to 20 basis points. What that means is that there are people who are betting against the government being able to solve this debt ceiling problem. It will be solved. Typically, this becomes more political than it really becomes a risk thing. And what you need to see is you need to see the markets have a little bit of a temper tantrum, and you start to see equities trade down. You start to see USA CDS trade up. All these things that will put pressure on politicians to eventually say, okay, enough's enough. We're going to, stop creating a partisan problem here, and we're going to actually solve the problem. So you will see this resolve. But I think more importantly, this is echoes the moral hazard that we're seeing in the market, which is for 12 years now, since the financial crisis of 2008 and 2009, we just continue to see governments come in and solve problems. And as a result, the market doesn't care anymore, right? The market just doesn't give any credence to these problems that are real because someone's going to sweep it under the rug and fix it. And when you start to see that moral hazard creep back into the markets where nobody really thinks anything's going to happen here, but at the same time, risk assets are down because we need the risk assets to go down in order to pressure the politicians to do something. It really kind of changes the game from an investor, right? You're no longer making investments based on individual investments in the market. You're making investments based on how you think this political theater will end up. I think what's different this time around from 2015 and 2009 before that and every other period where we've had these debt ceiling raises is that there's just a complete lack of trust in centralized institutions, right? Whether it's financial institutions or governments. I mean, even just this week alone, right? You have Robinhood and Citadel were basically caught red-handed in a case of trading on material non-public information. You had 2 of 12 Fed governors were forced to resign over insider trading. Congressmen across the country are being scrutinized for all of the lack of ethics they have around their trading. Just yesterday, the Pandora Papers came out, which shows a level of corruption across global leaders. There's just no confidence anymore in these centralized institutions, whether it's your bank or your local government or anything in between. So if you really want to make a case for why is Bitcoin up today, why are digital assets higher, part of it is that it just, everything that's happening in the world just continues to strengthen that notion of we don't want to be a part of this establishment anymore. We want to try something new. We want to be a part of something new. And I think the irony here is, in digital assets specific, we've been able to largely avoid the macro concerns, but we haven't been able to avoid the regulatory concerns. And here you are with regulators from the SEC and the CFTC and even into the Treasury here in the U.S. who are just constantly, trying to put fire extinguishers all over the digital asset market. And meanwhile, there's fires blazing behind them in their own industry, right? The financial industry, the traditional financial industry has all these different problems which are not being addressed. And here we are in digital assets trying to build something from scratch, and we're being shot down by the regulators. So I think that's a battleground that we're just going to see more of into the fourth quarter. We have real big companies now, from public companies like Galaxy and Coinbase to private companies, whether it's an OpenSea or a Kraken or a Gemini, whoever. There's real money that are going into lobbyists now. There's real money that's going into fighting these battles. And I think, we may see a much bigger opposition to some of these regulations and some of these restrictions than maybe previous market participants expected. So we'll see what happens in the fourth quarter. We're pretty bullish. We're expecting across different sectors of the digital asset space to continue to do well. And it feels pretty healthy to us despite the macro concerns. Last week alone, DeFi was down a lot, but gaming and layer ones were up. And that's been a consistent theme that we've seen all year, which is, 2 sectors up, 2 sectors down. It's no longer just this highly correlated market where everything moves together. So we're pretty encouraged by what's happening here. And we expect price action to potentially be choppy and volatile around this macro headwinds. But we certainly think that, October and the fourth quarter will be pretty strong for digital assets across the board. So that's it with 2 Satoshis. As always, if you have questions, we'd love to hear them. Otherwise, we'll see you back next week.